Today, we will talk about balloon payments, what they are, how they work, examples, pros, and cons. A balloon payment is the final amount due on a loan that is structured as a series of small monthly payments followed by a single much larger sum at the end of the loan period. The early payments may be all or almost all payments of interest owed on the loan, with the balloon payment being the principal of the loan. This type of loan is known as a balloon loan. The balloon home mortgage loan became common in the years before the 2007 to 2008 financial crisis. It allowed people eager to buy a home to obtain a mortgage payment that they could afford, at least in the early years. The balloon loan did not disappear with the financial crisis but is now more often used for business loans. A project can be financed with a loan that allows for minimal payments early on, with the balloon payment due only when the project is earning a return on the investment. The balloon payment is similar to a bullet repayment. As the term balloon suggests, the final payment on this type of loan is significantly large. In recent years, balloon payments have been more common in commercial lending than in consumer lending. It allows a commercial lender to keep short-term costs lower and take care of the balloon payment with future earnings. The same logic is used by individual homebuyers, but the risks are greater. Homebuyers are keeping their short-term costs low while assuming that their incomes will be far greater when the balloon payment comes due, that they will be able to refinance their mortgage before it is due, or that they can sell the house and pay off the entire mortgage before the balloon payment comes due. That strategy failed in the 2008 to 2009 financial crisis, when homeowners who financed their purchases with balloon mortgages found it impossible to sell their homes at a price high enough to pay off the amount they had borrowed. A balloon debt structure can be implemented for any type of debt. It's most commonly used in mortgages, auto loans, and business loans. The obvious advantage of balloon payments is the low initial payment requirement. The monthly balloon payment amount during the fixed period is generally less than the payment amount of a fully amortized loan. The timing of the payment size may mesh well with the borrower's income expectations. As the borrower's salary increases due to career progression, the debt obligation will rise as well. A balloon note or loan often has a shorter underwriting process compared to other loans. For this reason, there may be lower administrative or transaction fees in securing the loan. A borrower may also not be required to show as much documentation for this type of loan, as balloon mortgages often do not require a home appraisal as part of loan closing. A balloon payment structure is strategically advantageous for some borrowers. For example, people who flip houses can secure lower upfront monthly payments. The borrower has time to remodel the house and sell it before the balloon payment is due. This allows borrowers to preserve future cash flow for other purposes. Balloon payments can be a big problem in a falling housing market. As home prices decline, homeowners may be unable to sell their homes for enough to cover the balloon payment, and they might be unable to sell at any price. For home flippers, this means getting stuck with a high-interest rate loan should sales stall. Borrowers often have no choice but to default on their loans and enter foreclosure, regardless of their household incomes, when faced with a balloon payment they cannot afford. This results in the loss of the borrower's home. Balloon mortgages and auto loans may be difficult to refinance depending on the amount of equity that has been paid off. The loans may only pay interest early on. In this case, the owner may have little to no equity in the property despite making consistent payments for years. These types of loans can be harder to qualify for. Because principal payments are deferred, lenders often prefer borrowers with a high credit score or high down payment. In addition, to compensate for the flexibility of the principal obligation and increased risk for the lender, lenders usually charge higher interest rates for balloon debt compared to other types of loans. Here are 5 key takeaways. 1. A balloon payment is a type of loan structured so that the last payment is far larger than prior payments. 2. Balloon payments are an option for home mortgages, auto loans, and business loans. 3. Borrowers have lower initial monthly payments under a balloon loan. 4. The interest rate is usually higher for a balloon loan, and only borrowers with high creditworthiness are considered. 5. The balloon payment may be a weighted payment amount or, under an interest-only payment plan, be the full balance of the principal due. Hope this would help. Thanks for watching.